How to turn your home equity into a real estate funding machine. Let's get in. So here's a few stats. There's 17.3 trillion in untapped home equity sitting in US properties right now. The average homeowner has 284K of it, and most treat it as a passive number on a statement. What you're about to see is how to turn that sleeping equity into an active capital machine to expand your portfolio, one that stacks 3 layers of capital to give you deployable funding over 12 months or sooner. So here's the 3-tier stack. I'm Mick Wadley, founder of gapfunded.com. Gapfunded helps investors and business owners access the capital they need to close deals and scale portfolios without equity splits, without draining savings, and without giving up profit. So today's strategy is the most powerful version of the HELOC approach ever explained on the internet. Using home equity not just to fund a deal, but as a pivot point that unlocks 2 additional layers of capital simultaneously. Improving credit score, dropping your debt to income ratio, and qualifying for hundreds of thousands and 0% interest business credit. So let's get in. The 3 C's of capital, this is super simple to understand. Most investors work the first 2 and completely ignore the third. We can underwrite your profile on credit, scores and history, cash, income and revenue, or collateral, which is where the HELOCs sit on equity in homes, or LLC-owned investments, which a lot of investors don't even realize. So here's the problem and why most investors hit a funding ceiling. Every funding decision comes down to 3 factors: your credit, cash, and collateral. Most investors max out at the credit layer, high utilization, debt to income at 80 to 90% from MCA debt, and revolving balances drowning in car loans, credit cards, and MCAs that have been stacked on top of them on a high pressure sales call. Every lender sees a maxed out profile and says no. So let's look at each of the 3. You got your credit, personal and business scores, payment history, utilization, the standard path, and where most investors get stuck. You've got your cash, which is typical business loans, income, business revenue, bank statements. Lenders verify this to confirm you can service debt. Or what this video is all about is accessing the collateral, hard assets, your home, investment properties, paid off vehicles, retirement accounts. This is the bypass. Deployed correctly, it resets the entire credit picture and unlocks 2 more layers. So here's the 3-tier stack and how it works. Tier 1, secure an initial gap funding term loan stack, immediate capital deployed in typically 1 to 3 days. We can then move into deploying the HELOC as a strategic pivot, wipe out high interest credit card debt, reset the credit profile, and then be ready to stack massive 0% introductory APR business credit cards that won't report to your personal utilization when you max them out. Liquidate them into your own bank account as cash to use on deals. So a 50K approval ceiling becomes 500K or more in total accessible capital over 12 months or less. The initial term loan, fast capital to start. So your starting point is a standard gap funding term loan, unsecured capital based on your credit profile. This covers the immediate need, down payment, closing costs and working capital. Even with a stress profile, high utilization, elevated detail, a term loan can often be placed based on income alone, buying time while tier 2 does its work, while they underwrite your HELOC. So the key, secure this before touching any credit card balances. A term loan snapshot, for example, we can stack together multiple offers to go and get roughly 30 to 50% of your personal annual income, verifiable in your bank account. Deployed in 1 to 3 days. Fixed rate, we like to go for 5-year terms, so it lowers your holding costs. With no early pay down penalty, you can start these at a 650 credit score. Now, what this video is all about is tier 2, the HELOC pivot, the most misunderstood move in real estate finance. We don't use the HELOC to fund a deal directly. We use it to restructure the entire debt picture. Draw 40K at 7 to 8% to pay off 40K in credit cards, sitting at 22% interest. Now, the beautiful thing is many lenders will give you interest only. It's not a big lump sum of cash you're constantly paying off at a fixed rate. This is a line of credit. Think of it as a massive credit card backed by equity in a property. Your profile's at 0% utilization. We've dropped it from 80% to near 0 for the next reporting cycle in less than 30 days. Our clients typically see their FICO scores jump 40 to 80 points in this period because utilization is the biggest lever you can pull on your credit score. It accounts for about 30% of your FICO score. 500 to 900 monthly cash flow freed up, the difference between old credit card minimums and the new HELOC interest only payment. And then we get ourselves below the 35% DTI target. DTI drops from 80% to potentially under 35%, unlocking tier 3. So massive 0% business credit card stacking is now unlocked. I would say you don't want to go and do this unless you've got a 700 credit score, which is why we use debt consolidation to go and get you set up for this. Before the pivot, you might have been at a 640 credit score, 80% utilization, 80% DTI, applications declined or low limits. After the pivot, we've jumped up to a 710, near zero utilization, sub 35 DTI, maximum limit approvals. So what we do is we go and stack up to 4 business credit cards from Chase, American Express, and Citibank. We look at your location, your specific banking relationships to apply in the right order, the right sequence to get maximum funding at 0% introductory APRs for 12 to 21 months. Business cards from these issuers typically don't report utilization to your personal credit file, so stacking doesn't impact the score. We just went and improved. Cards are liquidated into deployable cash for deals via plastic. They typically do a 2.99% transaction fee, so if you've got a better payment processor in your own business, use that instead for deals, rehab, holding costs, STR furnishings, and reserves. At maximum approvals, first run, we can go get 55 to 150K and 0% business credit across a complete stack. Now, every deal you do, every exit you make, whether it's a fix and flip or a DSCR refinance on a BRRRR method, you've shown that you can max out those cards, pay them down responsibly. You can go and ask every card issuer you've got to increase your limits after every deal so that at the end of that introductory period, you're ready for a larger 0% stack and you've actually built your business credit and average credit limit profile. Now, here's the full stack. What 500K actually looks like in practice. So tier 1 term loan, say we get up to 160K secured before the HELOC pivot, covers immediate deal capital to get in and working capital needs before the first draw. Then the HELOC draws. So 325K on an investment HELOC eliminates revolving debt, frees up cash flow, resets the credit profile, but the more strong and powerful use case is keeping yourself open to those opportunities as you're going through the deal as well. Tier 3, 0% credit card stacking, so 55K in business credit cards at 0% for 12 to 20 months. Setting yourself up for a bigger stack at the end by increasing those limits step by step after every deal exit. So total we've got there is 540K. That's Angeline, a real client who completed this exact 3-tier sequence, and Nita, who turned 68,000 initial approval into 106K after a DTI dropped at reevaluation. So same concept, different scale, same result. Now, what you actually need to qualify for a HELOC. A HELOC's a revolving line of credit secured against your home equity, like a super credit card backed by your house or investment property. Draw periods, typically 10 years, interest-only payment option during the draw period on some of the prime lenders, and variable rate tied to the prime. So currently 7 to 8% interest on a primary residence, far cheaper than credit cards at 20 to 25% compounding monthly, or hard money at 10 to 14%. Typically, we're going to get an 80% CLTV. What does that mean? So that's the gap between 80% of the property value and mortgage balance equals the available draw. For example, a 400K home, a 280K mortgage would be a 40K available with that gap between 80% LTV and what you've got left on your mortgage. You want to be at least a 660 FICO. Some lenders go to 600, 700 plus for best rates because it is still personally guaranteed. It can be conditionally approved to pay down debt as well, so lowering DTI to qualify. DTI under 35% unless we are using it for the debt consolidation use case, ideally. Lenders can approve conditionally to pay down existing debt like MCAs, credit cards, and auto loans. Recognizing net DTI improves post-draw when you do have the line. The timeline, digital lenders close in 10 days. Traditional banks 2 to 4 weeks. Set it up before you even need it. So here's the red flags that delay HELOC approvals and how to fix them. Ghost liens, mortgages sold between services, leaving uncleared public records. The fix is a proactive county clerk title search before you apply. Silent blockers, HOA liens, IRS judgments, mechanics liens don't appear on personal credit reports, but lenders check public records as well. So the fix is to do a title search, verify release, and document proof on those. Entity complications. Property held in an LLC or trust requires a personal guarantee from the primary owner. Not a denial, just a documentation requirement. Variable rate risk. HELOC rates moves with the prime rate, so the fix is to model cash flow with a buffer. Don't assume today's rates for the full 10-year draw period. And that's why it's safer to use it responsibly on well underwritten deals, one at a time. Don't max out the whole thing and wait 10 years to pay it off, because your interest rate is going to fluctuate. An advisor who knows what to look for catches these before they become surprises mid-application. Now, to investors, this strategy is built. First, the maxed out operator. High revenue, high DTI, 90% credit card utilization, EA debt choking cash flow, can't access unsecured funding. Every lender sees the utilization. Has home equity. The HELOC is the bypass, so conditionally approved to pay down debt, instantly lowering DTI and unlocking the full credit stack. Then we've got the scaler. So a real estate investor mid-flip or mid-deal needing additional cash flow within that 10-day underwriting period has equity in a completed or performing investment property and draws from that equity via HELOC to finish the deal, then refinances or sells to pay off the line. Capital deployed, deal completed, line resets. Both personas have equity sitting idle. Neither can get there without someone who knows how to sequence the approach. Now, the bottom line, 7.3 trillion in untapped home equity. The average US homeowner has 284K sitting there. The three-tier stack turns that equity into a strategic pivot that restructures the entire credit picture, drops utilization to zero, frees up monthly cash flow, and qualifies you for hundreds of thousands in 0% credit over time. So here's the three-tier stack. Tier 1 term loan stack, immediate capital infusion for liquid, get into the deal, get the reset credit profile and reduce utilization, keep yourself open to opportunities coming along in the meantime, and then maximize your access to 0% credit stacking, interest-free lines. So I'm Mick Wadley. Let's go close something. Book a free funding review at gapfunded.com. Link in the description below. Just a soft pull, no hard credit check, and we'll be able to map out exactly what you qualify for or the best path forward for where you're at. Walk away with a full game plan.